Hello and welcome to a general discussion about accounts receivable. After viewing this video, you should be able to describe the transactions that create an accounts receivable, record sales discounts using the gross and net methods, and record sales returns and sales rebates. Accounts receivable is initially recorded when goods or services are provided to a customer and cash is expected to be received in the future. Most business-to-business transactions occur on account. Account means payment will be received in the future, typically 30 days. Interest is not charged on accounts, except when the account is way past due. Companies sometimes offer a trade discount to their consistent major customers. A trade discount occurs when goods are sold to a customer at a price below their normal list price. Trade discounts are also referred to as volume discounts. The purpose of a trade discount is to hide the real price to the best customers from competitors. A trade discount is not recognized separately when accounting for sales and receivables. The sale is just recorded at the price net of the trade discount. Sales discounts are offered for early payment. Sales discounts are offered to customers by companies that are in need of cash sooner than the 30-day terms. Sales discounts are stated in terms of the discount percent if payment is made in so many days or the balance is due in so many days. 2/10 and 30 means a 2% discount is given if paid in 10 days. If not, the full amount is due in 30 days. 1/15 and 60 means a 1% discount is given if paid within 15 days, or if not, the full amount is due in 60 days. N30 means no discount is offered and full amount is due in 30 days. The most common payment term is N30, and customers generally pay within 30 to 45 days. The gross method of accounting for sales discounts is used when a company does not normally offer a discount or when customers generally do not take discounts offered. Sales discounts are reported on the income statement as a reduction to sales. Sales discounts is a contra revenue account that increases with a debit and decreases with a credit. Here is an example of accounting for sales discounts under the gross method. The company sold $100 with terms of 2/10 net 30. The accounts receivable in the sale is recorded at the full gross amount. The accounts receivable account will always change for the full gross amount. Cash is lower than accounts receivable. So when the discount is taken and early payment is made, sales discount is the account used for the difference. If the discount is not taken, the full amount of cash is received, which is equal to the receivable. The net method of recording sales discounts is used when customers generally take the discount offered. The sale and accounts receivable is always recorded at the net price. If the customer pays the full price and does not take the discount, the additional cash is recorded as interest income and is considered a financing charge. Here is an example of accounting for sales discounts using the net method. This company sold $100 with terms of 2/10 net 30. The accounts receivable in the sale is recorded at the net amount. The accounts receivable account will always change for the net amount. A customer who takes a discount will pay the net amount and the receivable for the equal amount will be removed. The customer who does not take the discount will pay more than the receivable and the difference is recorded as interest income. The additional cash is considered a financing fee. Sales must be adjusted for returns when the customer has the right of return and the amount of returns can be reasonably estimated. Sales returns must be estimated and reported as a reduction to sales in the same period as the sale occurs. A right of return is common with books, technology companies, and medical supplies. The amount estimated for sales returns is generally determined using a historical percentage of sales. Sales for the current period is multiplied by the historical percent of sales return to get the estimated returns for the current period. This is the amount that reduces sales to get net sales. Sales returns must be estimated and reported in the same period as the related sale to follow the matching principle. Sales returns is a contra account that reduces sales. Allowances for sales returns is a contra account that reduces accounts receivable. The value of inventory that is expected to be returned must also be estimated and recorded in the same period as the sales return. Let's look at an example of sales returns. Jewel Manufacturing sold inventory with a cost of $120,000 on account for $200,000. Jewel's past experience indicates that approximately 5% of sales will be returned. Returned goods are put in the warehouse and sold to other customers. Customers actually returned $8,000 of goods early in the next year. The sales for the current period is multiplied by the 5% historical rate of returns to get the estimated returns related to the current period sales. Sales returns, which is a contra sales account, is recorded, and the allowance for sales returns is recorded as a contra account to reduce accounts receivables. Both are contra accounts. Customers are not expected to pay for returned goods, and the inventory related to the sale is expected to return is recorded in the same period also. When an actual return occurs, the allowance in the accounts receivable is reduced. Inventory is put in the warehouse, and the inventory account is increased, and the estimated returns to inventory is decreased. This gives no net change to inventory in total. The entries related to inventory are made only when items returned are placed in inventory and sold to other customers. Sales are adjusted for rebates when the customer or the buyer has a right to a rebate, which is a refund of a portion of the sales price due to reductions in the final sales price to the end user. The rebate effectively guarantees a distributor a minimum gross profit. This is common with technology or the medical industry. A sales rebate is recorded in the same period as the sale when the amount can be reasonably estimated based on past history. Sales revenue and accounts receivable are reduced using contra accounts. Let's take a look at an example of a sales rebate. Intel sells a chip to Dell Computer for $100 and agrees to rebate $4 to Dell if the computer chip is part of a computer that sells for between $701 and $900, and agrees to rebate $10 to Dell if the computer chip is part of a computer that sells for less than $700. Intel must estimate the amount of rebate that may have to be paid to Dell. It will be between $0 and $10 until the computer the chip is in is sold to a customer. Dell will then provide a report to Intel after the computers are sold and request payment of the rebate. Intel estimates the average amount of each rebate to be $5 and records an estimated rebate in the same period the sales of 100,000 chips is recorded. This estimate is generally based on past history. The two accounts used are contra accounts. Sales rebates reduces sales on the income statement, and the allowance for rebates reduces accounts receivable on the balance sheet. When the rebate is awarded and taken by the customer, the allowance for rebates is removed and accounts receivable is reduced. This entry gives no net change to net accounts receivable. The impact of the rebate is all reported in the period of the sale. This is done in the entry at the top of this page. Rebates is an estimated reduction to sales, and the actual amount may not be known for several periods into the future. Companies who estimate too low must add more when the actual amount of a rebate is taken. The amount of sales rebates in future periods will be lower in the future if current period estimates are too high. Current period estimates are always adjusted in the future when the actual amount is known. The income statement will say net sales when gross sales is reduced by a material amount. After viewing this video, you should be able to describe the transaction that creates an accounts receivable, record sales discounts using the gross and net methods, and record sales returns and sales rebates. Please go to studymyaccounting.com and work through the practices you learned for examples of accounting procedures related to each of the concepts discussed in this video. Then work the practice test. Please write out your answers and check your understanding to the answers provided. Thank you for being prepared for class. It is much appreciated.